Variable costing problem solver. Hello all. Let's do a problem solver where we review the difference between absorption costing and variable costing presentations. Again, when we talk about absorption costing and variable costing, what we're doing is we're looking at a company's operating performance and using two different methods to present the information. The absorption costing method is the method required by generally accepted accounting principles, and that's what all companies use for external reporting. In the method, again, we have direct material, direct labor, variable manufacturing overhead, and we also include a fixed manufacturing overhead in the total product cost. Problems like this will have information dealing with the selling price of the product, the inventory levels, the variable cost, and the fixed cost. This type of information gives you everything you need to solve these types of problems. You notice in this problem, the selling price is 200. When it comes to inventories, you notice that the inventory in the beginning was 0, so you have a dash there. They produced 2,000 units, so during the period, they produced 2,000. They sold 1,500, so they ended up with an inventory of 500. They went from an inventory of 0 to inventory of 500. You had an increase in inventory because production exceeded what was sold. Then you have a listing of the variable cost, the direct material, direct labor, variable manufacturing. These are all product costs. And then you have the variable SG&A cost of $2, which is a period cost. Last of all, you have fixed costs, and you have the distinction between fixed manufacturing overhead costs and fixed SG&A. All right, given that information, let's start doing this problem. The first questions deal with absorption costing. So the first question says, what's absorption costing unit product costs for the month? We look over here. Product costs include direct material, direct labor, variable manufacturing overhead, and some fixed manufacturing overhead. All right, so in the box, we're going to say we need to have direct material, we need to have direct labor, we need to have variable manufacturing overhead, and we're going to have some fixed manufacturing overhead. We're going to do everything on a per unit basis here. So we're going to put per unit up here. The direct materials are given, $25. The direct labor given, $35. The variable manufacturing overhead given, $15. When it comes to manufacturing overhead, we see that the total manufacturing overhead for the period was $100,000. Well, we don't want to put 100,000 here because we want to put everything on a per unit basis. To put the amounts on a per unit basis, what we would do is we would take that 100,000 and we divide it by the units produced. So I'm going to put a line here. And then in the per unit information, we're going to say 100,000 divided by 2,000 units is $50 per unit. At this point, we've determined all the elements of product cost. We have direct material of $25 plus direct labor of $35 plus variable manufacturing overhead of $15 plus fixed manufacturing overhead of $50. They're all on a per unit basis. We add them all up. We get $125. So now let's move on to question B. Question B asks, what's the total period cost using absorption costing? Under absorption costing, period costs only include SG&A. So they include both variable SG&A and fixed SG&A. So first we look for our variable SG&A. It's $2 per unit. We're going to multiply that by the 1,500 units we sell. So we're going to get $3,000. The fixed SG&A is $30,000 per month, so we're going to include the entire 30 because as a period cost, they don't get spread, they get expensed in a period. So then we add the two, the variable SG&A and the fixed SG&A together, and we get $33,000. So now it's time to determine the net operating income under absorption costing. To determine the net operating income under absorption costing, we take sales minus cost of goods sold to get gross margin, minus our SG&A costs, and we get our net operating income. And for our sales amount, we're going to take the selling price of $200, multiply it by the units sold of $1,500, and we're going to get $300,000. For our cost of goods sold, we're going to take the $125 that we calculated for total unit product cost, multiplied by the units sold, 1,500, we're going to get $187,500. The gross margin is going to be the difference between 300 and 187,500, or 112,500. Then we're going to subtract our SG&A. Typically in an absorption costing, you just lump it all together, and we would just put 33,000 here. But I'm showing the breakout here just to make sure that you're understanding where the number's coming from. So 112,500 minus the 33,000 in SG&A gives us a net operating income of 79,500 using the absorption costing method. Let's turn our attention to the variable costing method. For the variable costing method, we're going to do the same things. We're going to determine, first of all, the total unit product cost. Then we're going to figure out what the period costs are. Then we're going to prepare a variable costing income statement in order to determine the net operating income. Our first step for variable costing is to determine the unit product cost for the month. To calculate the unit product cost for the month, we add the direct materials amount for $25, direct labor for $35, and variable manufacturing overhead cost of $15 per unit. Summing the three up, we get a total product cost per unit of $75. You'll notice when we're doing the product cost for variable costing, we are not including the fixed manufacturing overhead or any portion of it. Now let's determine the total period cost. The total period cost under variable costing includes all fixed overhead. So it will include the $100,000 of fixed overhead. It'll include all fixed selling, general, and administrative costs of $30,000. Plus, it'll include the variable SG&A of $2 per unit times 1,500 units sold for $3,000. So the period cost, which it represents, again, all the costs that will be immediately expensed during the period, total the $100,000 of fixed manufacturing overhead, plus the SG&A of $3,000, that's variable, plus the fixed SG&A of $30,000 for a grand total of $133,000 for period cost under the variable costing method. Now it's time to determine the net operating income for variable costing method. The net operating income for variable costing method is determined by taking your sales minus your variable costs. The variable costs include all the variable costs of goods sold, or what you might refer to as variable product cost, plus the variable SG&A. Once we determine the total variable cost, we subtract it from the sales to get the contribution margin. From the contribution margin, we'll subtract all fixed costs. The fixed costs in this problem are the fixed manufacturing overhead of $100,000, the fixed SG&A of $30,000. So let's take a look at the numbers. For sales, again, we're going to take the $200 price per unit times the units sold of 1,500, 300,000. For the variable cost of goods sold is going to be the $75, which is the total unit product cost, times the units sold of 1,500 for $112,500. The variable SG&A is going to be the $2 per unit times the 1,500 units sold, $3,000. So we really have total variable costs of $115,500. Subtract that from the $300,000 in sales, and we have a contribution margin of $184,500. The contribution margin, remember, is designed to cover all of your fixed costs as well as contribute to net operating income. So let's see what happens here. Our fixed costs for manufacturing overhead is $100,000. Our fixed SG&A was $30,000. So we have a total fixed cost of $130,000. We have a contribution margin of $184,500. So we have more than enough to cover our fixed costs. The difference being our net operating income of $54,500. At this point, we've prepared an income statement using both methods, the variable costing methods and the absorption costing methods. And you notice that we got different results in each case. The variable costing method, $54,500. The absorption costing method, $79,500. So under absorption, we made more money than under variable costing. The key here is to understand why. First of all, let's recognize the amount of the difference. The difference is $25,000. If we take $79,500 and subtract $54,000 from it, we get $25,000. So the absorption costing method made $25,000 more than the variable costing method. The reason for that is the variable costing method expenses all fixed manufacturing overhead. So under the variable costing method, we expensed the entire $100,000 in fixed manufacturing overhead. Under the absorption costing method, we did not. Under the absorption costing method, we took the $100,000, figured out the per unit value of $50 per unit, and then we expensed only the units we sold. So we sold 1,500 units, we multiplied it by 50 and got 75,000. So 75,000 was expensed during the current period under absorption costing. What happened to the other 25,000? The other 25,000 in cost ended up as part of our ending inventory. So what did we do? We deferred that cost by putting it into an inventory, which is asset, and we'll recognize that cost at a later date once we sell that inventory. So what do we say we've done here? We say that we have deferred $25,000 of fixed manufacturing overhead. When will this happen? This is going to happen anytime the change in inventory results in an increase. So anytime that we produce more than we sell and our inventory is going to go up, we're going to have greater earnings under absorption costing than variable costing, because variable costing is going to expense everything, while absorption costing is going to defer a portion of it. The deferred portion goes to the balance sheet as inventory. The recognized portion of it goes to cost of goods sold as an expense on the income statement. That'll happen all the time. Yet another way to determine the net operating income difference between the two methods is to look at the change in inventory and multiply the change by the fixed manufacturing overhead cost per unit. The change in inventory is the difference between the 2,000 units produced and the 1,500 units sold, which is a 500 unit increase. We multiply the 500 unit increase by the fixed manufacturing overhead cost per unit of $50, which was calculated earlier, to calculate the net operating income difference of $25,000. Once again, the $25,000 is the fixed manufacturing overhead cost, which have been deferred by using the absorption costing method. That takes care of a comprehensive problem. Hopefully this is going to help you. Thanks for watching the video. Good luck.